What a bloodbath, so to speak, in our markets yesterday. That breach of 24K got a little bit scary, barring a few odd stocks like M&M and a few odd IT names. It was all a deep sea of red, led by, of course, banks, led by Reliance Industries. These were some of the names which really broke the back of the Nifty yesterday. Did resurrect a little bit, about 100 odd points from the session lows. But yeah, today is going to be the litmus test. Do you see a continuation of that move? That big FI selling continues, so that hasn't really abated. And to add to that, you've got, now the global charter points as well and data points which are going to dominate our markets. US markets have fallen, by the way, overnight amid that election uncertainty, Trump, Harris. The target keeps swinging. The swing states, of course, are in a very, very tight race. So net result, you've got a weak handover from the global markets as well. Largely about 0.5% to about 0.3% lower is how the US equity markets ended. What about Asia this morning? Let's just bring up that screen as well for you. It will give us a sense of whether or not there is any nervousness across the global street, or it was just a mildly tempered move across the US markets. Not quite China, Hong Kong in a different league of their own. They're of course holding up. The periphery markets definitely are looking a little bit bleak, as is our GIFT Nifty as well, which is indicating a mild start once again for us. But again, each day we talk about the GIFT Nifty, and then of course the course that the market takes in the intraday trade, that of course is a completely different picture altogether. But yeah, might as well, given that it's such a big queue, the elections, the global markets too are a little nervous.
Aisha, the problem is local, and you just can easily identify the why here, which is earnings, FI selling, valuations getting checked, money moved out because of large IPOs. So I'll get into global markets, but first let's really look at the why of the market and where and what you should do. I think that is very, very important. Now, the why is easily to identify, like I said. I think where we are headed in the near term is very difficult to ascertain. Not everything in the market is looking great, and not everything in the market is looking bad. In the month of June, July, maybe September, nothing was looking good in the market. But I think we are reaching that phase of the market where there were excesses which were getting created on the upside. Now there is a lot of fear and a lot of opportunity which is getting created on the downside. The bull market, folks, is not over. The temperament of the bull market has changed, which is that now we are going to be going to a stock pickers market, and that is where I think the market realignment will happen. We'll talk about themes and the sectors, but where we are headed in the near term, that I think is the most important address. And I think, so here's where I think markets are headed in the near term. Do not judge the market with the view on Nifty. In the near term, the mood and the momentum, they both have gone. But typically when the mood and momentum is not on your side, you want to start buying into the market. So the approach of what is, it's too late to sell. I think we are nearing that point where you should start buying. Not everything in the market is looking good, but there are a lot of opportunities in the market which are coming better. The market in pockets are becoming oversold now, and that is a typical sign when you go to brace yourself for a bounce. I think the selling, which is largely driven by local factors. What are the local factors? FI selling and earning disappointment. Earning disappointment is coming in the price. FI selling, difficult to judge, but you will not get everything on your side. I mean, if you want to be a buyer, you have to start buying when there is panic and when the prices are supportive. So I think we are going to go through that phase where markets will test your temperament. There would be volatile and painful weeks ahead. The price action may not be very satisfactory, but I think it's time now to start saying that, oh my God, this is the moment which I always wanted. We all wanted a correction. When the correction has come, stop
no
crying.
one has
guys.
the courage to
Yeah,
buy.
stop crying.
And they all want to time the bottom. But I think, I mean, in the very near term, it may make sense to let the US presidential election event get out of the way and then perhaps deploy.
Yeah, so by tomorrow, same time, or maybe by Wednesday, you pretty much would know that which way, the US has voted. So that's one big event risk that's behind us. Later this week, you will hear from the Chinese officials in terms of what they're doing with the stimulus package. So frankly, from a market standpoint and global market standpoint, by the end of the week, you pretty much would know that the large amount of the event risk actually would be over. And that's the point I'm trying to make here. The problem is not global, the problem is local. We'll talk about the US presidential election and how it's going to impact and all the data point. But the bottom line here is that in this kind of a market, when you are dealing with local problems, then you'll have to look for local solutions rather than global answers.
Yeah, and that's exactly how we'll have to look at the markets. And just to put it into perspective, yes, there was that deep sell-off that we witnessed yesterday, deep cuts within the broader markets as well. So it wasn't just the frontliners that were on shaky ground. 24,000 was a far cry by the time we wrapped up for trade. And it was in sectors across the board that felt the heat. The Nifty Bank, for instance, closed below the 51,500 mark. So that index too came under pressure. And even though you had an encouraging set of auto wholesale numbers for the month of October, that really failed to cheer the markets. And then, of course, there were those individual pockets. Banks was one, and then Reliance Industries was a big pain point in a trade yesterday. It cracked below the 50 as well as 100 and 200 daily moving average, and it contributed nearly 55 points to the Nifty fall. So a big pillar of strength crumbling under pressure at a 9-month low. Nikunj, at a time when we're looking at even the large caps succumbing to selling pressure, like Reliance Industries, for example, yesterday, and you're saying we need the courage to buy, where is it that we should look for these opportunities?
Okay, so I'll divide this into first 2 points, the technical aspect, which is like near term, today, tomorrow, and then we'll talk about opportunities, which are, let's say, for next 12 months plus. In the near term, I think the Bank Nifty holds the key. You just closed at 24,000 yesterday. Now, that's a line in the sand that you close above 24,000, the market is okay. You start going below 24,000, then market becomes into a weak zone. The Bank Nifty holds the key because the Bank Nifty has not fallen as much as what other indices have fallen. There you go. Energy, FMCG, MNC, infra, 10% I think is the average fall. The Bank Nifty is down 6% and that holds the key. Second, the FI in FNO I think is in terms of the total selling, it is in a sense just telling you that every FI is on the same side of the board. Even at these levels, either they are selling in the cash market or they're creating short positions. This is not going to last forever, which means that some turn I think should come. If the Bank Nifty holds on and if the FI turns, then you could see a bout of short covering. Conversely, the Bank Nifty goes down, FI short selling increases, then we could be staring at a lot of downside. So in the near term, which is this week, next week, global events, the positioning of the market, the technical setup is not indicative of a lot of strength in the market. But if you are a portfolio investor, this is a time when you would say that, okay, what is in for me? And that is the point. What is in for you is that the bull market is not over, the earning cycle is not over, valuations are becoming reasonable, and in some pockets they are becoming attractive. Private banks and some mid-tier banks, they become the go-to port of call for an investor. I think CDMO and pharma becomes another port of call. Anything which has got to do with energy transition, I think is a long, long way to go. If the government spending in the second half increases, then infra stocks will have a shot, and I think they could also make a comeback. And then I particularly like cement. Why? Because just think about it. I mean, cement prices in the last 3-4 years, they've done nothing. Real estate mein boom hai, infra mein boom hai, but real cement prices have not gone anywhere.
Yeah.
And why? Because there is a consolidation happening in that sector. There's one side is Adani, other side is Birla. There's a war to acquire assets, and the pricing is not coming back because companies are not increasing prices. I think that will get addressed.
Yeah.
If you like this video, then like, share and subscribe to ET Now.